Right, this is the 2018 flexible budget, the question 9. Um, so this is the question that threw a load, lads, back in the day. They hadn't studied it. It's unbelievably easy. Again, I know I say that about most of this management accounting stuff. This is quite straightforward. Um, so um, basically, normally the first question is to classify the costs as variable, mixed, or fixed. And if it is that way, that's variable. Direct wages is variable, production overheads is mixed, other overheads is mixed, and admin is fixed. Fixed cost is one that's the same at every production level. A variable cost is one that's in constant ratio. So if you took 108,000, I'll just show you this. So this, you don't have to do this, but I'll just show you. If you took the 108,000, that is direct materials, and divide it by 24,000, you will get 4.5. If you take the next level up, 135,000, divide that by 30,000, you get 4.5. That makes it variable. It's in constant ratio. Do the same then for wages. If you take the 124,800 and divide by 24,000, you get 520. If you take the 156 and divide that by 30,000, you get 520. So that's how you know it's variable. It's per unit. If you were to do the same with production overheads, you will get different answers when you divide them by 24,000 and 30,000, and the same with other. So that's why they're mixed. Part A of the question is using the high-low method. You saw this in your mocks. Using the high-low method, separate production overheads into their fixed and variable elements. So we'll do that first. So separate production overheads into the fixed and variable method. We use what's known as the high-low method. Now, the high-low method, I was explaining this to another teacher today who was asking me about what the logic behind it is. It's just creating simultaneous equations. That's all it is, because a variable cost is a cost per unit and a fixed cost is a static number. So if you took the variable cost per unit as being X, and if you took the fixed cost as being Y, well then units by X, so we'll just take for instance we're going to do the production overhead, so I'll just show you what it would look like in a simultaneous equation. 24,000 by X plus fixed cost of Y will give you 132,400. And then if you just move up a level, 30,000 by X plus Y, so 30,000 by the variable cost per unit, which we're calling X, plus Y, which is the fixed cost, will give us the next level up, which is 158,500. So now you've two simultaneous equations. 24,000 X plus Y is 132,400. 30,000 X plus Y is 158,500. So to solve those simultaneous equations, take them away from each other, you will get 6,000 X is 26,100. So X is 26,100 divided by 6,000. So which is 435. So that is what the high-low method is. Accountants don't see the need to put in X's and Y's, right? So if we're doing it in the high-low method, we go units and euros. So the high we'll take a different level just to show you. So we'll take the high level as 36,000 The low level will take us 30,000, so the difference is 6,000. Same thing, it's because it's all constant anyway. 184,600 is the high euros. 158,500 is the low, and the difference is going to be 26,100. Okay, so then the variable cost using the high-low method is the two numbers divided into each other. 26,100 divided by 6,000, which is what we got, 435 per unit. Okay, so now we slot that in. So we take whatever level you want, right? So the fixed cost, which is y, is going to be the 100. I'm going to take the low level here. 158,500 minus the euros times the price. So 30,000 by 435. So I'm just going to be lazy here and copy that, and you get the fixed cost being 28,000. All right, that's the high-low method. It's just solving simultaneous equations and slotting back in. So that is for production. For other overheads, I'm going to take the same process, and the only thing that's going to change are the euros. So we'll still take the 36 and the 30. You can take 36 and 24. You can take 30 and 24. It doesn't matter which ones you take. We'll take the 36 and 30. For the other overheads, 258,800 and 210. And then the difference between the two of them is 40,800. So the per unit, the variable cost, we'll take the 4,800, divide that by 6,000. And you got €6.80 per unit. Okay, we slot that 680 back in. So the fixed cost will be total costs 210,000 minus 30,000 multiplied by the 680. And again, that's 6,000 euros. Okay, you could take that 680 and slot it in for 36,000 as well. So it'd be 250,800 minus 36 by 680, and you'll still get 6,000. All right, so that was your high-low method for part A. Now, part B was sneaky enough. This is to get you, and this is a lesson in why you don't take too many shortcuts when you're choosing what you're doing. So it asks you to do something using marginal costing principles. So marginal costing came up the previous year. So any students who, like some of you lads, like to do as little as possible, would have chosen not to do marginal costing and maybe wouldn't have understood what marginal costing principles are. Those of you who've studied, it won't be a problem for you this year if it came up this way, but marginal costing principles obviously are where you split your costs into variable and fixed elements all of the time. Okay, so it asks us to do two things. This part B is actually marginal costing. It just doesn't call it marginal costing. So A part, or B, sorry, it says where is it? I haven't done part 3 yet, actually, before I move on to it. It says prepare a flexible budget for 95% activity using marginal costing principles and show the contribution. Well, it is using marginal costing principles. So for our units are going to be at 90%. 90, is it? Yeah, 95%, sorry. and we have to work out what our budget's going to be like at that point. Well, our direct materials, they're in relation to, so they're well, actually I should, sorry, apologies, make this easy for you. Our units at 95% are, we can take any of these levels, so say 36,000. We'll divide that by 90. That'll give you 1%. Multiplied by 95 will give you 95%. So at 95% level, we make 38,000 units. Our costs then, so our variable cost first of all. Okay, we've got our direct materials. Now you can do this one of two ways. I'm going to show you both on the page. So you can say we worked out the direct materials were 450 per unit. So we can go 450 by 38,000. And that'll equal the same as taking 162, or any of these levels, 162 divided by 90, multiplied by 95, or divide by 36 and multiply by 38. It's all constant, so 171. So if you take 38,000, just to show you, 38,000 by 450, by 450 is 171. Okay, you can do it whatever way you want. That's completely variable cost. Second one is the direct wages. That's completely variable. So again, that was 520. We showed that at the start. So 5.2 by 38,000 is 197,600. There's two other ways you can get to that, as I said. Take your, which I'll go with this 124,800. No, yeah, go to 124,800. So if I took that 124,800, if I divided it by 24,000 and multiply by 38,000, I'll get 197,600. Or if I go 124,800 and divide that by 60, multiply by 95, I'll get the same answer, 197,600. So there's three different ways to do that. And the same with the direct materials. Right, the third part then is the production overheads. Only the variable element. So the variable element is 435 per unit. So it's going to be 435 by 38,000. That's the only way you can do this. There's no other way. So 4.35 by 38,000 is 165,300. And the last one was the other overheads. And we take our answer from the variable from the first part, which was 680 per unit. And we're going to multiply that by 38,000. And that is 258,400. All right, they're all your variable overheads. Just be careful when you're adding them up to do not include the 38,000. All right, the fixed cost then. Fixed cost, well, we've got our admin. That's completely fixed, so 40,500. We've got our we've got the fixed elements of then our production and our other. So the production overheads, we've got this 28,000, and then the other overheads, we've got the 6,000. There are our fixed costs. So we'll add them together, and finally add the two costs together. That's marginal costing principles because you split your costs into their variable and fixed elements. Now, it did tell us one more thing to do, which I hadn't read. I was sort of rushing through. It told us to work out the contribution. So, as we know, contribution is sales minus variable costs. Now, I'm not sure if it says anything about sales. It just says profit is 20% of sales, right? So that means costs. Again, this is like we worked out in question 8. This is our total cost, right? Well, if total costs are 886 and profits are 20% of sales, well, then costs must be 80% of sales. So then sales must be 100%. So we'll take that. So for our profit, we're going to take that 868,800. We can divide it by 80 and multiply by 20. Okay, and that'll give you your profit. And then your sales, I'm going to do it up here, do both places, but sales is obviously the two of them added together, or 866,800 divided by 80 multiplied by 100. So 108,3,500. Now I need to move that up here. 108,3,500. And sales minus variable costs is contribution. So 108,3,500 minus 792,300 is 291,200. Okay, you can show it down there as well as if you want. You don't have to show that line at the bottom. So if you've understood marginal costing principles, you'd have no problem in that question. So it's sort of a sneaky enough thing to throw in because most people don't do marginal cost or don't do costing and budgeting. I'm hoping all of you lads will understand that there's only a few things to do in costing, so it's very worthwhile doing it if they were to ask it this way. Okay, so that's part A. Part B. Now this is again marginal costing, and it's a very sneaky way of doing it. It's basically a marginal costing question asked in a flexible budget manner. I think something like this was in your mocks, something similar enough to this was in your mocks. Anyway, part B. Assume that Conlon is currently operating at 100% and is considering two capital options. Okay, so he's at 100%. So his units at 100%, again, take whatever level you want, 36,000 divided by 90 multiplied by 100 would be 40,000. So just bear that in mind that the units of 40,000. Okay, so you can do this like really quickly if you want. Anyway, there's two options. Modernizing machinery will save 60 cents per unit in the production overhead. So you could write out, well, you can if you want, you could write out all of these again and just take 60 cents off one of them, or in the production overhead if you wanted. That's the way I'm going to do it because it's the way the market scheme does it. You could do it really quick, but you could just add up 4.5 plus 5.2 plus 4.35 plus 6.8 and then take away 60 cents. All right, and then multiply whatever answer you got by 40,000. That will give you the total variable cost. I'm not sure if the marketing scheme would be, or if the correctors would be too impressed with you for doing that. So we'll keep all the costs separate. So direct materials, that remains at 450. So it's 4.5 by 40,000, which is 180,000, I think. Yeah. The direct labor, which is 5.2 by 40,000. Which is 208. The production overhead, it's going down by 0.6. So it goes from 4.35 down to 3.75. Taking away the 0.6 off the 4.35 by 40,000. Which is 15,000. And then the other overhead is still remains at 6.8 by 40,000. So that's 810,000. Okay, gonna leave a space for your contribution. Your fixed costs, well, they're going to remain the same. So you could be cheeky and just, as I said, write them all, just write the total of 74.5. But looking at the marking scheme, they were given 1 mark for each of them. So production was 28. Other was, just these numbers again, other was 6. And the admin was 40,500. So we'll add those together. Okay, the total costs. Total costs are 884,500. So they equal, it's still the same process. They equal 80%. So I'm going to work out the sales. The sales will be 100%. So sales then is that divided by 80 multiplied by 100, which is 110,565. So 110,565. Take away your variable cost to get your contribution, and take away your fixed costs to get your profit. Okay, so that's the first option. The second option, buying new machinery, which will increase the plant's capacity by 10% while reducing all fixed costs by 8%. Doesn't say how much the machinery costs. It doesn't really matter. I suppose it's an asset. So we do the same thing. Units, they're going up by 10%, which means we're going from 40,000 to 44,000. It's the same sums. So your direct materials, it's the same sums, not as up here, by the way. It's as in your originals: 4.5, 5.2, 4.35, and 6.8. So your direct materials, 4.5 by 44,000. Let me just clean this in a bit. So sales, variable costs. Your labor is still 5.2. It's times by 44,000. Just 228. Production is, it's whatever it was initially, 4.35 by 44,000. And your other is 6.8 by 44,000. Which is 299,200. Okay, so you'll obviously add those together. Okay, your fixed then, they're all going up. Every one of them is going up by 8%. So your production is 28,000 by 1.08. again, if I was doing this, I would just multiply the 74.5 by 1.08. That's the answer you get. But again, the marking scheme is looking for it's looking for, sorry, it's not by 1.08. Are all the costs going up? It's going down, so it's by 0.92. So, so the other overheads are going, they're all going down. So 6,000 by 0.92. And then finally the admin 40,500 by 0.92. So that gives us our costs. Okay, and our total costs, two together, are that, and that equals 80%. So the sales then, again, is 100%. So it's that divided by 80 multiplied by 100. So 1, 2, 3, 2, 4, 2, 5. And you can just work down. So your contribution, which it's specifically asked for, 1232425 minus 917400 is 315025, and 315025 minus 68540 is 246485. Sorry, just let me get down my 100%. Do this again for you. The numbers changed as I slotted them in. Okay. So that's that done. It asks you specifically, and you get marks for it, which one should you do? Well, which one gives you the most profit? Well, option 2 gives you more profit than option 1. Should have never labeled them profit. Anyway, so you should go for option 2, and you will get marks for saying that. Part C, distinguish between contribution and profit. Contribution is sales less variable costs, and contribution is used to pay off the fixed costs. So variable costs and contribution is used to pay the fixed costs of the business. Can't really know what else to say there. Profit is sales less total costs, which would be your fixed and your variable together. Okay, so that was straightforward enough. Outline why you prepare a flexible budget. So it allows you to show profits at different levels. It allows you to, well, all budgets allow you to compare costs, actual costs, to budgeted costs. So it's a control mechanism. Might be no harm to call them variances. And then they allow you control costs. Okay, so I think not many were looking for marking scheme is only 5 marks there, so obviously not an awful lot. Okay, so that's that question done. I think of the two of them, question 8 was a good bit easier and a good bit quicker. they're both quite straightforward, really. But question 8 was a little bit easier there. Question 9, you could see how it could throw people, given the, as I said, the marginal costing thing that came up the year before. Anyway, it'll be up to you which ones you do. I will be finishing question 8s when we come back. I'm not 100% sure what I'm left to do, but sure, worry about that next week. All right, so that's that paper done, bar the manufacturing again, which I'll get done tomorrow, hopefully. All right, we'll see you. Good luck.